Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Bhansali, I am so excited to talk to you today. Before we get going, I'm just going to do a quick intro. It might be a slightly longer than usual intro because there's so much in your background. And then we'll talk about your thoughts on risk management, on markets. So you started in physics at Caltech and eventually got your Ph.D. at Harvard in theoretical physics. You oddly drifted, perhaps because of timing, into finance. You ended up working at Citibank, Salomon Brothers, Credit Suisse, First Boston. You ended up spending a decent amount of your adult life at PIMCO before leaving and starting your own firm, LongTail Alpha, 10 years ago. That seems crazy to me. I remember when that happened. You've written a number of books, including books on tail risk hedging. And on the personal front, you are an ultra marathon runner and an aviator with thousands of flight hours. I read something in a piece you wrote recently about how you got into finance. And I'll read it because I just thought it was utterly brilliant. The super collider had just gotten canceled and the US economy was in a recession. This is 1991, is that correct?
Yep, exactly.
My postdoc prospects after finishing a doctorate in physics at Harvard were in Europe, but Wall Street and Goldman Sachs were looking for physics people to model options. I received a call from a search firm. I went into Goldman for an interview and sat across from an elderly gentleman who wrote, does not know any finance, but is very good at math. I later found out it was Fisher-Black of the Black-Scholes formula. So is that how you ended up in this mess that you're in?
Yeah, basically. So I actually declined the job to work in research at Goldman, and I decided that instead of doing that, I would take another job that I knew even less about, trading derivatives, because my plan was to only stay in finance for a year maximum. So it felt like if I'm going to do the sabbatical, do something that's actually a little bit more out there. And, the way life works, I ended up trading options. And guess what? Fisher-Black and Black-Scholes and all the other stuff, the ghost of Black still oversees my life, I guess, in a way.
As you know, I was a student of Bob Merton, so we have a lot of that DNA in common. So you ended up going to Salomon Brothers, Credit Suisse. I mean, these are just incredible household names, certainly for people in our neck of the woods. And then you drifted west, I guess, and you ended up at PIMCO. When was this transition?
So PIMCO was right in 2000. So I just reached out to Bill Gross in 98, 99. He had written a book. And at the time, I was at Salomon Brothers, and then I went to Credit Suisse for 1 year, proprietary trading. And Bill reached back out to me and put me in touch with Jim Keller, who was head of fixed income, came out for an interview. And once Salomon got shut down, Salomon was basically the preeminent fixed income trading shop at the time. And Salomon got shut down in the aftermath of travelers buying it. The obvious place in bonds was to go to PIMCO. But once I got an offer, it was hard to refuse.
Right. And so this is the turn of the century, obviously, in the equity market. We know what happened there with the tech bubble and the burst thereafter, starting in the spring of 2000. At that point, when you're joining PIMCO, you're in the fixed income space, or you're thinking multi-asset class?
No, it's interesting. I've been a bond trader and derivatives trader for a while, but what they really needed was somebody to build out analytics. So my actual official job hired was I was in charge as portfolio manager, but in charge of all the quantitative portfolios and analytics and parts of risk. But what actually happened, I landed, and basically the next day I was handed a big binder, which was bonds under management, Bill Gross's big binder. And I was told that I was going to be managing about 50 global bond portfolios because another senior portfolio manager was leaving. So suddenly I had two jobs. And that was very typical of PIMCO in those years. It was basically a small firm, very driven. And if they found that you had skills to do anything, you would get that job on top of your other jobs. And, it kind of self-selected. There were a lot of people like me there who liked having multiple things to do and always kept us busy. So yeah, I was basically a portfolio manager in charge of all analytics for the whole firm, building the team out, but then also in charge of portfolios. And very quickly thereafter, within the next year, another partner by the name of John Haig, he had the idea that maybe we should get into absolute return, taking some of the PIMCO Alpha and creating a real hedge fund out of it. So we started the first PIMCO hedge fund together called the Global Relative Value Fund. This is in 2001, 2002.
And that's right around the same time that obviously you guys started working with research affiliates on the all asset strategies, so on and so forth. But then eventually, I guess that quantitative effort you started really grew into a full suite of strategies. I remember the trend following a program that you were running, that sort of thing. I guess this is more in the 2010s. And then eventually, in 2015, you started your own firm, Tail Risk Alpha. And as much as I want to talk about your firms, obviously you and I like to talk about ideas. And so when you say Tail Alpha, like what is that concept in your mind?
Yeah, basically, the way I think about it as an option trader, my lens is always looking at the world from the point of view of probability distributions and basically the whole distribution, not just expected return and volatility and skewness and so on. And so that's basically a physicist trading is, Richard Feynman, who was, when I was at Caltech, he used to teach a class called Physics X. And I actually had a good fortune of working with him as an undergraduate research associate for 1 year, unfortunately, before he passed away. But, Feynman always used to say, once you know your distribution, you know everything, right? So in physics, once you know the PDF, the probability density function, you basically know everything. And if you can forecast it, which is basically all physics is about trying to forecast the evolution of the density function, you know everything, right? So again, without getting too mathematical and wonkish about it, when I look at the PDF or the probability distributions, it's very easy to see that the distribution is not a simple distribution that you can just quantify by just looking at mean and variance and maybe even some of the higher moments. So the whole distribution matters. And the tails basically are where all the action is, because in the local probability events, whether it's on the left side or the right side, markets are not very well understood because people don't get to trade them. Something that's close to at the money, like it happens every single day, you can trade it all day long and you can get a pretty good handle of what's going on. But if you look at the things that are unlikely to happen on the left side or the right side, it's just not very well understood because there's not very much data, it's very sparse. So how do you actually calibrate it? And that's where it's basically a self-selected endeavor for us, because if you can find something that's even slightly better than what the academic and practitioner literature tells you, there is a lot of value, there's a lot of alpha. So we focus on purpose on looking at the tails of the distribution, because we believe that if you can build good models and adjust for the illiquidity and transactions cost, there's still a lot of really interesting, valuable alpha in that space.
Right, kind of extreme outcomes, low probability, high impact, and to your point, often where the models aren't well developed, and certainly where just humans haven't spent a lot of time because, well, that's the nature of extreme events, right? So all of a sudden, you don't have the models, you don't have the experience, and so maybe things like mispricings or certainly relative value, I guess, come into play. Obviously, when I hear the term tail risk, and very quickly that drifts into thinking about insurance and protection. And I'm reminded of something that Bob Merton used to say very often in class and beyond. He used to say, the only thing worse than not having insurance is to think you do when you don't. So how do you think about that? I guess people walk around either blissfully unaware of extreme scenarios or thinking they have them covered when they don't, right?
Yeah, exactly. And I think, to a certain degree, again, I'm not an insurance salesperson, but my approach is to think about the total portfolio. And what happens is basically returns, which are obviously critical in terms of, long-term generation of wealth, are absolutely critical. And to the degree that people are focused on return generation and growing their wealth and compounding and all that is all very good. But one of the problems that you face in real life is that markets don't tend to go up in a straight line. So running a portfolio or any kind of investment, even without having some sort of game plan for dealing with extreme, sudden, unforecastable drawdowns is very important because it gives you two things, right? One, it gives you the ability to not panic and sell. And then secondly, it also allows you the opportunity to buy assets when others are panicking and selling. So from the point of view of long-term compounding of wealth, it's pretty obvious that staying in the game is critical. And typically for hedging, usually the cost isn't that much. But in the desire to maximize returns, people have forgotten that staying in the game, compounding is where the real wealth comes from. And compounding can be enhanced if you don't get out and panic in bad situations. So yeah, and to Burton's point, he should know because, with LTCM and so on, they found that they were trying to basically create portfolios that were internally diversified, so to speak. And, people relied very heavily on this idea that correlations would be stable. And of course, what we know is correlations are not stable. In real markets, participants can move correlations to extremes. And that's basically, I think what he's saying, which is completely accurate, is that if you believe that diversification, which is obviously true and it obviously works, is the only lever you can pull on for providing that protection in severe drawdowns, then you're going to be mistaken occasionally when diversification does not work. 2022 is a great example, right? When inflation started to rise, correlations broke down, stocks went down, bonds went down. Nothing really worked. This year, during Liberation Day, in early April, same exact thing. You could have had a very diversified portfolio, but nothing really worked except having some sort of contractually purchased explicit tail hedges or insureds. Now, it's not just for the left side. People just focus on the meltdowns. It turns out that in today's markets, the right side, the upside, is just as imperfectly priced. I mean, there's a huge demand for equities, there's a huge demand for assets, but because of various underlying dynamics in the market, even call options systematically trade too cheap relative to what they should be trading, given these new dynamics. So we're pretty agnostic about the direction of the market or the side of the market. All we're saying is that you can create better portfolios by creating more reliable, robust assets on both sides of the distribution.
Interesting. On the left side of the distribution, I guess a reasonable analogy is as a town, right? You can choose to fire your fire department, and that's going to feel pretty good until, of course, you need them. And then turns out having a bunch of firefighters around might have been worth the pay all along. Tell me more about the call option thing to the extent that you can, because particularly in the current world that has emerged very quickly over the last couple of years with zero-date to expiry options and what I would describe as a gamification of investing in a lot of ways, I actually would have anticipated call options to be in relative high demand. So I guess I'm curious about your thoughts there.
Yeah, so this dynamic actually started probably right after the global financial crisis when the central banks became quite active in terms of providing liquidity. And I've written a number of papers on this, including a couple of papers in the Journal of Portfolio Management. One of the ones that I'll mention here is called right tail hedging when markets melt up. And what we found is that because of the amount of liquidity that was provided in the markets and the development, like you just mentioned, of the options markets, and of course the development of Robinhood and so on, it became very easy for people to trade options. So the short-dated part of the option, the 0-DTE, 1-DTE, 5-DTE, the very, very short-dated ones, that is really a retail type of market, and that's not the space where institutional investors focus on because it doesn't really provide you with a long-term portfolio benefit. It's really for speculation. So when I am referring to call options, systematically trading cheap, I'm talking about longer dated options where people use them for risk management type of reasons. So when we did this analysis, and this is part of the research paper on the right tail, the paper that I just mentioned was published about 5 or 6 years ago. What we found is that if you account properly for the jumps in the market, so you use a jump diffusion type of model, and you simplify it very simply by just using a simple up-down coin flip binomial type of model, and you compare it where option prices trade, what you find is that the market is not pricing up jumps. And there's a reason why, because the academic lore has always told us that markets tend to jump down and become illiquid, but markets tend not to jump up because everybody's long equities and so on and so forth. But that has changed, in my view, quite substantially because there is a lot of demand for equities because of gamification, like you mentioned, but also because of passive products, right? The 401ks are buying the same stuff and the market goes up. They have to buy more of the same stocks. The concentration that everybody talks about has gone up. And then because of option purchasing, there's a net imbalance of gamma. So when somebody places a big order, let's say, on one of the larger stocks, there's just not enough delta for the hedger or the seller of the option who sold that call option to buy. Now, you compound that with a few other things. There's been net buybacks from the large companies like Apple and others. I mean, astounding amounts of buybacks, hundreds of billions per year. So they are also reducing the net supply in the equity market.
And the actual Delta One equities.
Correct. But because they're reducing the net supply, basically what it leads to is less instruments to hedge the call options in those equities, and those call options then are part of the index because, these 7 or 8 large companies are about 40% of the index. So I think that there's an imbalance, and that imbalance translates itself into very vicious rebounds and jumps. As a matter of fact, if you took the S&P 500, you turn it upside down, you might find that now what looks like a down is actually an up jump. The up jumps are actually more vicious statistically than the down jumps.
It's really interesting. And I think that makes sense, right? To think about, there is the expectation theory of prices. And then, of course, there is the mechanical flow reality on the ground. And to your point, when people are buying options and people are hedging on the other side, that's number one, which means they have to adjust their hedges. And in a world where there are just fewer and fewer shares, just kind of kicking around, that certainly makes a lot of sense to me. You were talking about Liberation Day. That feels, of course, like ancient history, April 2nd of 2025. But then there was April 9th, where we had one of the most vicious melt-up days, certainly that I remember since the depths of the financial crisis. We had some plus 10, plus 12% days in the middle of the financial crisis, and here we were again on April 9, right?
Yeah, it was milliseconds. I mean, literally, once the tweet came out, I think the market was up 12% in like 30 or 40 milliseconds. I mean, literally, it was instantaneous, right? And I think that just tells you how big these imbalances can get. There's also other stuff here, right? I mean, you can go down and start peeling the onion, go down deep into the rabbit hole. There's a lot of electronification, electronic trading. So when there's large moves, many market makers quit making markets. The market actually become quite illiquid on both sides. It all comes down to why options markets exist, right? I mean, there's this whole lore which says that one should never buy out-of-the-money put options. One should never buy out-of-the-money call options because you can always replicate them using Delta One securities. It's just not true when you cannot transact or transaction costs become higher. And that's the reason why options markets are expanding. Now, one other point I should mention is that there's a lot of press discussion about how the people who participate in zero-DTE and short-dated options are irrational, right? And so again, I've written a paper on this topic, and one conclusion that I came to, that it's not as irrational as it might seem. It actually could be quite rational. And the logic is extremely simple. When yields were at 4 or 5%, the short rates were really high, and people had, let's say, $1,000 of capital in their bank account. If you take $1,000 of capital and take, let's say, $45 in this example of interest income per year, right? 4.55%. You take the portion of that, divide $45 by 200 or 250 days. Let's say it gives you like $1 or whatever, half a dollar or $2 per day of speculative trading. If you just, every single day you come in there and you just spend your interest income buying out of the money call, one share, once in a while, it will move, right? Because the markets are fat tail, and you'll make back all the other days when you spent premium and didn't get anything. If you can do that, and you can then also somehow influence the network, a social network, and everybody spends $1 or 50 cents, now you can actually move markets collectively. And so it becomes a very rational strategy where you're only spending your interest income, but you are creating a massive positive skew in your portfolio. And every day the options expire, because that's what zero-DTE means. So you have no mark to market, and you're effectively running a massive levered option position every single day where you're not putting up margin capital. You're only putting up the premium. So I think there's a way that you can look at these short-dated option, retail speculation and say, it's actually not as irrational as one might imagine it is.
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode. I think that's right. I think it's rational behavior given the economics on the ground. And yet, my understanding of the data is, certainly to date, has been a very clear net flow of dollars from the buyers of those options to those selling them. So far, it's been a wealth redistribution process for the people that are spending the $45 interest income.
Yeah. And it's a very important point, but I should mention that's exactly right. And this comes back to the heart of why we do what we do. Is on average, you're absolutely correct. If you were to average over all the participants, you would find on average they have lost money and market makers have made money. The narrative, the story, there is the 1 or the 5 or the 10 or the 100 for whom it has been life-changing, right? It's like buying a lottery ticket. And the reason these markets exist is not because of the average, it's because the fat tail can actually be life-changing. So if you think in terms of the utility function of this retail speculator who's doing it, he knows on average, it's not like he's dumb and he's got to say on average, I'm going to make money. He knows on average, I'm going to lose money. If that nice little event happens and that person makes 100x, it's a life-changing, right?
Yeah, there's no question.
That's why people buy lottery tickets. Exactly.
And that's exactly right. Again, I don't mean to be disparaging of when I describe the gamification of investing. I think the reality is the gamification of investing is part of a bigger societal situation where a lot of people feel like this is their one shot. And, if you're living in an environment where you feel like the odds are stacked against you, then you start doing things that are narrowly rational because, they might be your one path out, even though they might not be good for your health, if you will, in other ways. The equities are painfully obvious when it comes to the fact that there are very thick tails in a lot of ways. Fixed income to some degree. And then, of course, there's currencies, right? Where the narrative behind currencies is, well, it tends to be kind of bounded, right? Unless something terrible happens and your currency is worthless, then, they operate in a range. But of course, we still see jumps along the way. So how do you think about probability distributions in currencies, I guess?
Yeah, so very interestingly, currencies, we're trying to identify kind of the salient characteristics of different types of asset classes, right? So again, a currency is not an asset, it's just a exchange of one for another. And they tend to move in very long macroeconomic cycles. And of course, we should be very careful not to overgeneralize. You've got the developed market currencies and the emerging market currencies. I don't know much about the EM currencies, but on the developed market currencies, which I've now traded both in the form of forwards and futures and swaps and options and all that, there tends to be a macroeconomic driver, which has to do with large, long time scale global realignments, right? So currencies tend to not move very much when things are in equilibrium. But when you start having a large change in these macroeconomic conditions, they tend to move a lot and they persist. So the tails, we've only talked about the tails in kind of the one time slice dimension. So you look at one time and say, well, who's fatter? Is equity fatter or, currency or commodity? Who's got the fat tail? And it turns out, of course, equity, the fat left tail, certain assets like gold had a very fat right tail for obvious reasons because it's a counter to, inflation and so on. Currencies show both types of dynamics. But there's another dimension, which is not about looking at just the tails for one fixed time slice, but looking at the time horizon dimension.
Relative to history, right?
Correct, relative to history. And what happens here is that if you look at the cumulative effect of time passage on currencies, currencies actually have a very, very fat tail in that time dimension, just like things like inflation. Bonds have the same type of dynamic. If you look at, let's say, inflation doesn't have a very fat tail in the short time horizon because inflation takes time to build up. But if you accumulate it, you find that over periods, inflation has a very persistent, fat dimension. But you have to kind of expand your time horizon. So the way we think about currencies here is that it's similar to maybe credit a little bit. When there's big macroeconomic realignments going on and stuff starts to happen and they start to move, they are going to move and they're going to keep moving. And that's when it's very important to be on the right side of the trend. Comes back to my history on why I started trend following, is because in many cases, if you can put that time dimension properly at the right time, without trying to be a macroeconomic forecaster, you can just look at the market behavior. When the market starts to behave in a way where it starts to break various types of levels and various types of prior equilibrium points, you find that it tends to continue for a while.
Right.
And it's happening, in my view, right now. We're actually probably beginning to see some big moves happening here. Again, my framework, I'll just say this one thing about currencies is we do believe that a 30-year secular cycle of falling rates, falling volatility, credible central banking is all coming to an end. And we have turned the corner already starting in 21, 22, maybe 2020, when a lot of economists were, especially central bankers, were saying take yields even more negative. I think that was a turning point. And what we're seeing now is a multi-year, multi-decadal secular transition towards maybe a return of a pair in like 60s to the 80s. If you go and look during that period where you get large movements in various currencies, you also get large movements in precious metals like gold and silver and so on, which we've written a number of research papers on. So I think currencies, broadly speaking, including gold, silver, Aussie dollar, Kiwi dollar, etc., are set for large moves in the years to come.
Yeah, I mean, as you said, lucky for us, we're definitely not going through a global economic realignment, right?
Yeah.
So let's take that as our pivot or transition. Again, there are times when markets and the economy seem to be behaving in different ways. People have a tendency to say things like markets are not the economy. And that may be true in the short term, I guess. But again, what you're saying is in the longer run, somehow like we all live in the economy. The markets can't stay disconnected for too long. Obviously, we did just experience, and maybe the starting point, people can debate whether it was 2020 or maybe April 2nd, 2025. But as you're thinking about the global shocks to the global economy, how do you think about diversification and all that? Someone's going to say, well, I've got equities. I might have global equities. I have bonds and maybe some private credit. Where do you draw the line where you say, okay, diversification is doing something for you, or you're kidding yourself? You're actually exposed to one fundamental source of risk.
Yeah, I think you said it already. I think what's happened in the last 20, 30 years is we've gotten so used to equity markets going up, and equity markets, obviously, the Merton model, or just by observation, you can see are related to credit. You can put the chart of the S&P versus the credit default swap spread of the CDX index. You'll say they're right on top of each other. So really, there's one exposure that everybody is exposed to, which is equities. And as long as equities keep going up, we'll be in great shape. But if equities fall because of inflation rising or central bank policy, monetary fiscal policy not being as friendly as it has been, then you're in trouble because bonds also fall at the same time. So this thing that we've relied on, where all the visible liquid markets data is for the last 30, 40, 50 years, all argues that diversification worked. But what we're saying is, even though it's a low probability outcome at this moment, if you end up in a scenario where we get into a 60s to 80s type of volatile, persistent, non-credible central bank, fiscal profligacy, whatever you want to call it, people are in trouble because there is no way for diversification to bail you out until yields get to, 15%, right? Hope that doesn't happen. But if yields are at 15%, it solves a lot of problems because the income will subsidize things. But right now we're at bond yields at 450, 475. So you're pretty far away. So basically it's very simple, right? You can rely on the magic of diversification where the last 30 years you've been gifted with diversification coming for free while stocks have gone up and bonds have gone up and credit has gone up and real estate has gone up. Or you can say, wait, if the world changes, we want something that's more robust, more reliable. And again, I'm speaking my book here, obviously, but the one thing that is graduated and has become a real asset class is volatility. Because of all the participation and knowledge building and democratization of trading, volatility can be traded by pretty much anybody, meaning options can be traded and options are on sale, right? So from our perspective, it's just hard to not say, do everything else also. Do diversification, manage your portfolio with a lot of cash and liquidity in it, but at the same time, look at creating some reliable protection against that one big bad event that might knock you out of your portfolio and then rebound, and you're not going to be part of the rebound when that happens. So that's probably my single most important message, is trying to build some sort of reliability into your portfolio at this time.
And you're right. I guess we now live in a world where everyone can trade options. It doesn't mean that everyone's equipped to do that on their own. So I guess that certainly is a motivator for your business model. You just said something that's really interesting about building resilience and kind of setting yourself up to work through the pain, I guess, in a lot of ways, to the extent that pain's on the menu. And again, I'm reminded you're an ultra marathon runner. That means, for people who don't know, running things like hundreds of miles over the course of multiple daylight cycles. You've done, some of these races in Death Valley in the middle of summer. I guess someone along the way said something to you like, hey, look, the number one job is don't die. And there's something to that in what you just said, of course, which is the first philosophy is to have resilience and to be able to kind of survive. I talk a lot about existential risk to portfolio, right? To the extent that we can't completely eliminate it, you're trying to minimize existential risk. Everything else is another day at the office. And of course, I'm reminded of the fact that we all have kind of different views on this. John Maynard Keynes, of course, famously said, in the long run, we'll all be dead. So I guess so much for don't die. And then, of course, Chuck Prince had an infamous quote along the way as the financial crisis was going underway, saying, well, you can't stop dancing until the music is over, which I guess is setting yourself up for a pretty abrupt death. So how do you think about that?
I think it's all about knowing why you're investing in the market in the first place, right? If the reason to invest is to create a great long-term lifestyle for you, then it becomes essential that you don't get out or get forced out. So I think the single moral for the way I approach investing is never be in a situation where you get forced out of your investment, right? Because you're kind of out of the game and you're kind of dying that premature death. And the same thing in running also is, the whole plan is you have a destination, you want to get to that destination feeling reasonably good. And then, it's going to be hard, it's going to be volatile, the conditions are going to be bad, but you can plan for it, right? So that's what we're saying here. It's not about products, it's not about assets. You know that there's a terminal place you want to end up. And every single day you're coming in, you're saying, optimally, how do I get to that place in the most comfortable, most reliable way possible? And that's effectively the way we look at the markets. And all we're doing is providing people with the analysis and the strategy and the insights on how to get to that destination.
I think there's something else in this preparation exercise, I guess, that you're encouraging people to do, which is if you don't prepare and you find yourself in these tight spots, right, where survival becomes a life consideration. And of course, I don't mean actual survival. I mean, in the sense of financial matters, it can create a lot of malincentives along the way. Think about banks, investment banks in particular, where all of a sudden their trading desk in the middle of '08, their number one job is, can we get to tomorrow? And when your number one job is, can we get to tomorrow? Then all of a sudden you might be finding yourself making really hard ethical, moral decisions. Do I prioritize self-preservation or the interests of my clients? I mean, I understand the natural evolutionary pressure for self-preservation, but what is the point of doing all of that if you don't have the currency, the trust and moral currency to be in business tomorrow, right? So I guess in a lot of ways, you get to choose whether you do it without preparation, and then you're going to face a lot of these strange dilemmas, or maybe you prepare yourself for resilience ahead of time.
Exactly. I think that's exactly it. And I think that's what truly investing is all about. And why investing attracts so many people, obviously, like you do and others as well, is because it is not a task that you can do passively. Certainly, you can invest passively when you come to actually putting money into the markets. But investing is about designing a disciplined system of considering trade-offs, right? And there's no easy way to just throw money at the markets and get lucky every single time. So I think that's what preparation is about. It's about knowing where the risks and rewards lie and what really matters to each individual investor. That's one other thing I've learned after having done this for 30-something odd years is that not every investor is the same. Everybody is different and everybody's objectives are different. And so it's extremely important for somebody who cannot take the risk, let's say a public pension that's severely underfunded, to protect against this existential downside risk. On the other hand, there could be another endowment or a person who's severely overfunded so they can self-insure. They don't have to buy insurance, right? So the objective is very different. And financial instruments should not be treated as uniform for everybody. The value actually comes from your inherent objectives.
Yeah, you have to meet the people in the institutions where they are. Veneer, this has been an incredible conversation. I think we could go on for hours. And if we did, we might end up actually speaking mathematics, which I don't think would be necessarily fun for everyone. So on the way out, I have a series of kind of quick fire questions I ask everybody. As you know, I grew up in Paris. I used to watch French TV. And there was a cultural show hosted by Bernard Pivot where they talked about books and literature, how very French. And at the end of it, there was a series of questions. The same questions were then translated to American TV by James Lipton for the Actors Studio. So are you ready for a series of quickfire questions? And you can answer them as literally as you feel or as freely interpretive.
That sounds good. I don't speak any French, you know that, right?
That's going to be okay. These are in English.
Yeah.
What is your favorite word?
Oh, it's probably resilience, I think. It's very close between learning and resilience. I think that's been the secret for me having survived as long as I have. Yeah.
Is your least favorite word?
Probably greed. Greed is probably the least favorite. Yeah.
What is your favorite drug?
Oh, probably double espresso in the morning. And that's the only medication and drug that I take. So I guess that is my favorite because I've been doing that for 35 years every single day. Yeah.
What is a sound that you love?
Oh, that's a very interesting one. So I am a very sensitive or very light sleeper, and I get disturbed by sound a lot. So I love the sound of silence. We have a place where at nighttime, you sit outside and you can actually hear nothing and you can hear yourself breathe. So I would say that's probably my favorite sound is like a sound of nothing. It kind of sounds weird, but there are times when you just want to turn it off completely. Yeah.
What is a sound or a noise you hate?
Traffic noise a lot. Yeah. I've always been very annoyed with that. But yeah.
What is your favorite curse word?
Oh boy, I don't know if you can say that here. Maybe I'll pass on that one.
Okay.
Yeah.
Who would you like to see on a new banknote?
That's a really interesting one. In the U.S., that's interesting. I haven't even thought about it. Who's on it right now, by the way?
That's a bunch of presidents, right?
It's a bunch of presidents, right? Yeah. I think we just continue the tradition. It's probably what we have. I didn't really have a view on that. I'm sorry. Yeah.
What is a profession other than your own you would never, ever want to attempt?
The thing is, a friend of mine, maybe he'll listen to this, he told me one time he went underwater in freezing Minnesota, cold climate, with an electric chainsaw to take down a couple of peters. They had to cut wood underwater in a frozen lake. That's probably one profession I would not try.
You would elect not to do that if given the choice.
Yes.
If you were reincarnated as a plant or an animal, what would you like to come back as?
The camel, I mean, that's pretty easy. I grew up in the desert in India. The camel has always been my favorite animal. I grew up with camels around our hometown of Jodhpur. And to me, they are weird, gawky-looking animals, an apparition of nature, but they kind of signify all the things related to resilience and surviving and keeping on. So I think that's probably the animal that I'd like to come back as. Yeah.
Love it. Well, one last question. Are you ready?
Sure.
If God exists, what would you like to hear them say when you arrive at the pearly gates?
Oh, I think, what would I like God to say to me? Like,
yeah.
Somebody, you lived up to their potential. Yeah.
Well, this has been an incredible conversation. Thank you for your time. Again, so much to consider as we enter 2026.
Likewise. Thank you, Jonathan. Take care.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, treussard.com, for additional information and disclaimers.